Welcome to the debate. Imagine closing a multinational corporation's books, not in 2 weeks, not in 2 days, but in 2 milliseconds.
Which sounds completely terrifying, by the way.
Well, right. That's exactly what we are here to figure out. Is that the ultimate operational utopia or just a massive governance nightmare waiting to happen? Because, look, if you walk into any enterprise finance department around the 28th of the month, you can literally feel it.
Oh, absolutely.
The whole atmosphere shifts, right? Tension rises, people stay late, and there's this massive choreographed scramble to reconcile the past 30 days, the infamous month-end close.
Yeah, it really is a visceral shift. I mean, for generations of accounting and finance professionals, this periodic cycle has felt like a law of physics.
Exactly.
You operate for 30 days. You freeze everything, and then you spend a brutal week trying to figure out what actually happened.
But today we're examining an architectural shift from our source material that basically challenges that entire premise. We are looking at the emergence of the autonomous finance function, and this is driven specifically by Generation 2, chain of action AI agents.
Right, the agents that actually do things.
Exactly. So the central question we are debating is this. Will this new architecture systematically dismantle and eliminate periodic financial cycles entirely, replacing them with just a continuous real-time signal?
Or, on the flip side, does the absolute requirement for human governance and, ethical judgment and complex estimations, does that mean that structured periodic human review remains an insurmountable structural limit?
Right. Because we are drawing this directly from recent analysis regarding AI agents across tax, treasury, and record-to-report functions, as well as these big predictions about the last month-end close.
Yeah, it's a bold claim.
It is. And I hold the position that real-time architecture, when you pair it with these new agentic AI systems, systematically dismantles the need for a designated month-end close. It seamlessly shifts the finance operating model from a periodic calendar to a continuous signal.
And I take the opposing view. My position is that, yes, operational data gathering and reconciliation will absolutely be automated. But the necessity for humans to apply complex judgment, organizational context, and governance intrinsically prevents the complete elimination of structured, periodic financial cycles.
Okay, so to understand why I believe the month-end close is basically facing extinction, we have to look at why it even exists in the first place.
Fair enough.
I mean, it wasn't handed down on stone tablets as the optimal way to run a global business. It's a technological relic. It's an artifact of a pre-digital age, necessitated by the simple fact that historically, financial data lived in completely disconnected systems.
Right, you had your point of sale systems over here, your payroll over there, your inventory, and none of them were talking to each other natively.
Exactly. So you had to wait until the end of the period to manually gather the data, reconcile it, find the errors, and correct them before the numbers became official.
Right.
It was a constraint of the environment. But what we are seeing now is a profound shift in the actual nature of artificial intelligence. If you look at, say, 2020 through 2023, the first generation of enterprise AI was basically a chain-of-thought technology.
A very smart chatbot, essentially.
Right, a highly sophisticated research assistant. It could look at your disconnected data and generate a nice summary, but it couldn't act.
It completely lacked operational authority.
Precisely. But Gen 2, this new agentic era, is defined by the chain of action. These agents don't just analyze data, they actually possess the bidirectional connectivity to execute workflows directly within enterprise systems.
Which is a huge leap.
It is. They integrate natively with ERP platforms, payment gateways, tax authority APIs. So when you combine this continuous execution with real-time transaction data, the operational constraints that literally created the month-end close just evaporate.
Okay, but
You no longer need to wait 30 days to assemble the truth because the truth is continuously assembling itself.
Look, I completely agree with your characterization of Gen 1 versus Gen 2 AI. The difference between a tool that suggests an action and a tool that executes an action is night and day.
Yeah.
And continuous reconciliation is a massive operational leap forward. I'm not debating that. But where your argument overreaches is in assuming that operational execution is the only thing happening during a financial cycle.
How so? I mean, if the data is instantly reconciled, what exactly are we waiting for?
You have to look at the fourth layer of autonomous architecture described in our material. We have the foundation of structured data, sure. We have the connectivity to act and the orchestration of agents. But the apex of this architecture is governance.
Okay.
And this is exactly where the continuous signal hits a wall. The text is remarkably explicit on this point. It says humans must evaluate complex judgments and estimates that algorithms simply cannot assess.
But aren't those judgments largely mathematical at their core? I mean, algorithms are pretty good at math.
Not at all. Think about what a financial close actually represents. It's not just matching debits and credits across intercompany accounts. It involves making highly subjective estimations.
Like what?
Well, asset depreciation schedules, bad debt reserves, contingent liabilities for ongoing lawsuits. These determinations require deep organizational context. They require an understanding of macroeconomic shifts and, frankly, stakeholder awareness.
And you're saying an AI agent with all of its processing power can't process those inputs?
I'm saying you cannot apply contextual estimation at the continuous microsecond speed of a transaction. The human mind, and more importantly, organizational consensus, does not operate at API speed. Well, think about it. If you were assessing the risk of a supplier going bankrupt, to determine a bad debt reserve, you have to draw a line in the sand at a specific point in time to make that call.
Right, but
The data gathering is continuous, yes, but human governance intrinsically demands a cycle.
Okay, let me push back on that, because the text outlines 3 things that change first, which directly challenge the idea that we need a designated pause for this review.
Okay, let's hear them.
Those 3 things are reconciliation, reporting, and compliance. In the legacy model, reconciliation waits for the calendar. But in the autonomous model, it is just a continuous background process.
But a background process still encounters exceptions. It doesn't fix everything perfectly.
True, but let's look at how it handles them. The reconciliation agent doesn't just read a bank statement. It logs into the ERP, matches the transaction ID, verifies the amount, and if there's a missing penny due to a currency fluctuation, it automatically books the FX gain or loss based on preset rules.
Right.
It does this thousands of times a minute. It resolves the vast majority of exceptions instantly.
Okay, but what about the ones it can't resolve?
Let me offer an analogy based on the text. Think of Gen 1 AI as a brilliant analyst trapped behind a glass wall. They could see a massive payment anomaly on a screen. They could point to it, but they couldn't reach through the glass and hit the keyboard.
Sure.
Gen 2 breaks the glass. It grabs the keyboard. It has the bidirectional connectivity to reach into the ERP and trigger the mitigation directly.
But
And because it's doing this continuously, the executive reporting isn't a historical snapshot of last month anymore. It's a live visualization. The compliance filings, like quarterly VAT returns, they just vanish in favor of continuous submission models. When the operational reality is perfectly reconciled at every second, stopping the entire organization for a week to close the books becomes an absurd redundancy.
I'm sorry, but I just don't buy that. Let me tell you why. You're conflating the automation of the components of the close with the elimination of the event of the close.
How are those different? If the components happen continuously, the event itself is obsolete.
Look at the specific phrasing in the source material. It states quite clearly that the closing cycle doesn't disappear overnight, but rather that it compresses, and then it compresses again.
Right, down to 0.
No, not to 0. It describes a future where the week-long process becomes a real-time confirmation. Let's unpack what a confirmation actually is. A confirmation is a finalization event.
But a real-time finalization event.
Yes, but even if your reconciliation agents are continuously running, as I mentioned, they inevitably generate exceptions they aren't authorized to fix. Governance includes the framework for exception handling.
Okay, sure.
The algorithms will encounter a vendor dispute or some complex contract anomaly that they cannot automatically book. So, at some point, a human authority must look at the continuous flow, review the escalated exceptions, apply judgment, and formally state, this period is accurate and finalized.
So you're saying the close just becomes what? A review of what the machines couldn't figure out?
Exactly. I mean, if you're a controller listening to this right now, you know there is no way an AI is signing off on your final bad debt reserves without your oversight. The nature of the close absolutely changes. It goes from a brutal week of manual data entry to a highly elevated review of exceptions. But the need for a finalization event, a boundary in time, remains fundamentally intact.
Okay, I see why you think that, but let me give you a different perspective on how human governance is actually applied in an agentic framework.
Let's hear it.
Actually, wait, let me stop you there because I'm genuinely a bit stuck on this. If we have agents constantly making decisions in the background, doesn't that create a chaotic, wild west of data? Help me understand how governance even works if there's no monthly pause to check the math.
Well, that's exactly why the pause is needed, to prevent the Wild West.
But see, that is applying a legacy mindset to a new architecture. To understand how we avoid chaos without a pause, we have to move to the third layer of the architecture.
Agent orchestration.
Exactly, agent orchestration. We are not just talking about individual bots doing isolated tasks. We are talking about an intelligence layer coordinating multiple specialized domains simultaneously.
Give me a concrete example of orchestration replacing the cycle, though.
Okay, let's look at Treasury agents. The text explains that these agents are continuously monitoring cash positions across all global jurisdictions. They are querying banking APIs, assessing currency fluctuations, optimizing payment timing, and executing intercompany settlements in real time.
Right.
They don't wait for a weekly Treasury Committee meeting to decide how to balance liquidity in Europe.
But humans still have to govern that risk. They can't just let the agent move millions unchecked.
Yes, but the governance framework is not a weekly meeting where humans sit down to review the agent's work after the fact. The governance is the parameters designed by the humans in advance. The human role shifts entirely from execution to design.
Meaning,
Finance professionals design the boundaries, the risk tolerances, the ethical parameters.
they build the guardrails.
Exactly. Once those guardrails are set, the orchestration layer executes continuously within them. The human is not acting as a periodic toll booth on the data highway. They are the engineers who designed the highway.
Okay, but
If a transaction hits a parameter wall, it's flagged instantly, not at the end of the month. The judgment is proactive, not reactive. Therefore, a calendar cycle is irrelevant.
that sounds great in theory. But proactive parameter design has strict limitations when you introduce external reality, which is, frankly, constantly shifting.
What do you mean?
Let's look at another specific example from the text. Tax optimization agents.
Okay, sure.
The material notes that these agents can analyze transaction flows in real time and identify structuring opportunities within defined legal frameworks to reduce the effective tax burden. Now, from a purely algorithmic standpoint, the agent can continuously optimize.
Which is what you want.
Right, but the text makes a critical distinction here. It explicitly states humans must make decisions requiring stakeholder relationships and ethical judgment.
But surely we can code legal and ethical boundaries into the parameters, right?
You can code legality. You absolutely cannot code organizational ethics or shifting stakeholder dynamics.
I don't see why not.
Let me walk you through a scenario. Imagine an agent finds a perfectly legal loophole to route intellectual property profits through a subsidiary in a specific low-tax jurisdiction.
Okay.
The math works perfectly. It saves the company $2 million immediately.
Sounds like the agent is doing exactly its job.
Mathematically, yes. But a human CFO knows that that specific country is currently undergoing severe political turmoil. And utilizing that loophole right now would create a massive PR nightmare with public stakeholders and local regulators. The move contradicts the company's public ESG commitments. So the math passes the parameter check, but the ethics fail the reality check.
So you're saying the AI lacks contextual awareness.
Completely. You cannot pre-program the nuances of global political relationships into an algorithmic boundary. Evaluating the ethics of a tax structure requires stepping off the continuous treadmill.
Right.
It requires a periodic gathering of human leaders to look at the macroeconomic landscape and apply context the agent simply doesn't possess. Tax planning cannot be a purely continuous discipline because ethics cannot be calculated at the speed of a transaction.
And yet, if we wait for a periodic cycle to make those ethical evaluations, the transaction has already occurred, and the opportunity or the risk has passed.
Which is why the cycle compresses, but doesn't vanish. You need a fast review, but you still need a review.
This actually brings us to the practical reality of how finance leaders are building these systems today. Because the difference between an organization stuck in your periodic cycles and one operating on my continuous signal comes down entirely to foundational data architecture.
The plumbing.
The plumbing, exactly. We hear these technical terms thrown around all the time, right? S/4HANA migrations, SAFTI mandates. But tell me what that actually means on the ground for this debate.
Well, right now, organizations are being forced by regulatory mandates to upgrade their systems. If you're a controller, SAFT is basically Europe's standard way of demanding your tax data electronically and continuously.
Right.
And S/4HANA is SAP's modern enterprise software foundation.
Right, but there is a massive divergence happening in how companies treat these upgrades. Organizations that view an S/4HANA implementation simply as a narrow compliance chore to just spit out a SAFTI file, they're building a fragmented foundation.
They are just bolting new software onto old processes. It's a huge mistake.
Exactly. They are implementing point solutions that trap data in local silos, and when data is trapped in silos, it inevitably requires a human to manually reconcile it at month end.
Yes.
But the organizations building for true intelligence are creating what the text calls canonical data models.
Which, for those listening, think of a canonical data model simply as a universally agreed upon single source of truth for every number in the company, rather than 30 different spreadsheets arguing with each other.
Precisely. They are building centralized orchestration layers with real-time connectivity. When you have a canonical data model where every e-invoice, every continuous tax submission, and every treasury movement flows into a single, validated layer in real time, the entire concept of stopping to assemble the picture becomes obsolete.
You're saying the structure does the work.
Yes. You are building an environment where the architecture itself enforces compliance.
That's a compelling argument, but have you considered what the text identifies as the ultimate human constraint in this unified environment?
Which is what?
It says, and I quote, "The constraint is no longer the capacity to gather and process information. It is the capacity to ask the right questions of an information environment that is richer and more current than anything previously available."
Okay, but asking questions can happen continuously. Why does that need a cycle?
Look, I agree completely that a fragmented architecture is a roadblock, and canonical data models are the required foundation. But think about the cognitive act of asking the right questions. High-level strategic questioning is inherently a reflective exercise.
Sure.
When a CFO looks at a unified intelligence dashboard, they are not operating at the microsecond speed of the continuous transaction.
No, they're looking for trends.
Exactly. They're looking for patterns, they are modeling future scenarios, and assessing overarching strategy. Strategy fundamentally requires a temporal framework.
You mean looking at time periods?
Yes, you compare quarter over quarter or year over year to measure progress against a thesis.
The continuous signal is the operational reality, yes. But human cognition, strategic planning, and asking profound questions about the direction of the enterprise require periods of aggregation.
You need to stop looking at individual drops of water to see the direction of the river.
Yes!
Yes.
That's exactly it. You need a designated moment to step onto the bank and map the terrain. That is why the cycle, the close, however compressed, elevated, and automated it becomes, will persist as a structural requirement of human leadership.
Okay, so to summarize where we stand, my position remains that the month-end close is essentially a byproduct of technological limitations that are rapidly disappearing.
Right. The combination of real-time structured transaction data flowing directly from regulatory compliance mandates, paired with Generation 2 chain of action AI agents, systematically removes the operational constraints of the past.
Because the agents execute the work directly.
Exactly. When agents have the bidirectional connectivity to natively execute workflows, instantly reconcile ledgers across platforms, and optimize treasury operations continuously in the background, the finance operating model transitions away from a periodic calendar. It becomes a continuous real-time signal. The architecture itself simply outgrows the need for the designated month-end pause.
And my position is that while the underlying operational data flows will indeed become perfectly continuous and automated, the cycle itself will survive because of the elevated human role.
The strategic side.
Yes, the brutal operational burden of manual data gathering vanishes,
But managing complex estimates, navigating the nuances of global stakeholder relationships, and applying ethical governance simply cannot be automated at transaction speed.
The speed of the machine outpaces the speed of consensus.
Precisely. The continuous operational signal provides perfect data, but the profound human responsibilities of governance, exception handling, and overarching strategy inherently demand a structured cycle of review and reflection.
Well, what we certainly converge on today is the undeniable reality that the traditional manual data gathering exercise of the pre-digital finance calendar is entirely obsolete.
Oh, completely.
The days of armies of accountants frantically cross-referencing spreadsheets late into the night are over. Both of these perspectives highlight that building a unified, real-time data infrastructure is not a hypothetical future state, but an absolute, immediate necessity.
Absolutely. The foundational layer of clean, structured, machine-readable data is entirely non-negotiable at this point. Organizations that continue clinging to fragmented point solutions are essentially maintaining a museum of past inefficiencies.
That's a great way to put it.
The transition to this new agent-driven architecture is happening right now, forced forward by relentless regulatory pressures and massive technological leaps.
Reflecting on this debate, the value of examining this transition through both lenses is, honestly, incredibly high. The central question for finance leaders today, whether they are undergoing migration simply to build narrow systems for compliance, or whether they are taking the opportunity to build unified architectures for true intelligence, will definitively shape their operating performance and competitive position over the next 3 to 5 years.
Without a doubt, the infrastructure choices made today dictate the capabilities of tomorrow.
Precisely. The exact balance an organization strikes between the autonomous continuous speed of its AI agents and the reflective periodic governance of its human leaders offers so much more to explore within this material.
It really does.
We started by picturing the rhythm of the finance department, right? The palpable tension and inevitable scramble of the month-end close. Whether that rhythm flattens out into a perfectly continuous, automated hum, or whether it simply evolved into a higher-level cycle of strategic questioning and ethical review, one thing is certain.
What's that?
The calendar that has dictated the lives of finance professionals for over a century is being fundamentally rewritten. Thank you for joining us, and we leave it to you to decide which future you are building toward.